Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up for this Thursday, and this is the 8th of February, 2018, and the time about 4:13 p.m. Central Standard Time. We're getting ready in Chicago for anywhere between 9 to 12 inches of snow that starts at 6 o'clock tonight and wraps up sometime on Friday. Wish I could tell you if people are going to be able to make it to work or not. Don't know. I mean, it's a lot of snow in a short period of time, so you just don't know how that is. So I'm putting everything out, wrapping myself up. If you don't see me tomorrow, you now know the reason. I'm generally here, so it'll take a big snow to stop me from coming in. What's going on in the market? I began writing my newsletter a little while ago, and what I see going on in the markets is a watershed event where central banks, literally around the world, not every one, but literally, are gradually now easing, coming out of their easy money policy that began when we had the Great Recession that hit in 2008, and they're in some phase getting ready to leave that posture and move to a tighter monetary policy. That doesn't mean that everything's coming to the end in financial markets. We're going to get back to what's called more normal. It doesn't mean corporations aren't doing well, but it does mean higher interest rates are coming, and will they do as well? That is the big question. We can still see that even with the big decline that we saw today in stock indices, bonds and notes, futures at least, they are still falling, which means yields are really going higher. You can see that you were down pretty good in these markets. Gold caught a bid, as I mentioned in my gold update, against the first price count. Now, that happened to tie in with the lower Bollinger Band as well, and that offered the market some support. And of course, seeing stocks slip down, that's another factor that often gives it a little support. But keep in the back of your mind, if, and this is the word if inflation is really coming forth in economies around the world, not just the U.S., well, that is something you have to adjust your thinking for. I'm not talking runaway inflation. I'm talking wage inflation, some inflation. That gets people to thinking. When we look at the S&P 500 index, you can't get away from what this chart is showing. It was in last November when the president, I'm not talking early November of 2017, this November, 2016, the last time we had a close this much under the 18-week moving average of closes. There's been a change in the market. Now, if we step back, this is how the market looked at the beginning of this week. Just the beginning. We hadn't opened yet. This is what you're down for the week. So you lost 117 points the week before. I certainly don't know where this week's going to end up. I don't have that crystal ball. You're down another 5.93%. So 5.93, 4.1. We're sitting at a 10% correction because from its peak, you had been higher. So we're in a correction phase. The Dow theory, other theories that you may read, 10% numbers can lead to further. 20% corrections often lead to bear markets. We're nowhere near that. We're in a corrective phase. Keep that in the back of your mind. When you look at this chart, there is a reason that yesterday when I was on Fox, I said it is time to pick up your chips, assuming you're at a gaming table, go to the bar, have your drinks. And the reason is you can't beat this volatility. I welcome you to, and that's what day trading is about. I guess if you're a position trader also, but the heat in the kitchen is monstrous. These aren't small moves. At $50 a point, you figure it out. You're a $4,000 move. If you misstep, you can get yourself into trouble. This isn't normal. These ranges were normal. This is that crazy volatility that comes in when events change in a marketplace. At least that's my opinion. When I look at the swing line, you've got lower highs now, certainly the lower lows. So until the market comes back over 27, 26.75 on this pattern, this particular one, which is pretty far away. I think you'd agree. You have a market that's in a downtrend. The market has not been able recently to get up to the 18-day average of closes. That's bearish. It has hit now, out of the past 4 sessions, 3 times the 100-day average of closes, and it's back under the lower Bollinger Band. You had a couple of days under, you popped over, you're back under, and where are we in momentum? We are getting into a pattern of oversold. So we have a market that's in a downtrend. It crisscrossed under the 100-day moving average of closes. Hadn't done that in a very, very long time. You saw in the weekly chart that you're under things. We have a change of events. And getting back up to these old highs is not going to be happening very, very soon, I think. Doesn't mean I'm right, but it's my own thought. When I go to the NASDAQ, same thing. Oversold market in a downtrend. This one's been in it. It's had the lower highs, lower lows. But let's assume you wanted to get short under that 18-day average as momentum was turning down. In all honesty, anywhere here, were you going to really risk back up to 7,000 and whatever from 6,700? I mean, you might tell me you were, and I wish you the best, but I wouldn't know where to put a stop, even if you wanted to put one right over this high, this day's high of 69.91. So a hard market. That's still a 200-point risk any way you cut it. And now I start looking at what's the Bollinger Band. You slice through it, and that was Monday. Okay, we're only at Thursday. Next stopping zone might be the 100-day average. You hit that. You bounced away from it, and now you're back down to it. That's all that you're doing. It's wild, except that it's wild right here. In the Dow, you fell back into today, the 100-day average, the Bollinger Band. Not quite as oversold. You've got readings here, neither number under 30, so I don't think this market's yet oversold. Could it bounce away and just track here? Yes, but there's nothing bullish on the charts. The charts have all turned down. That doesn't mean individual stock picking might not be a good time to do. It just means what the indices are doing. And the Russell was the leader of the parade. It's still down. It, too, is a market that isn't in oversold territory. When we look at the VIX, it's not back up to 50. This day broke the back of many of the funds that were playing that the VIX would not take back the volatility. And I, for one, had been telling you as you were basing out here, you've got to be very careful. You can come right back to this. Go to what we had. I said, you know, I'm questioning if we aren't making a trading bottom here. And we started pushing out at it. And I said, I'd be careful. And don't believe me? Tapes say it all by themselves. And then you got this washout day. I mean, unbelievable. Took down some of the VIX funds. But here's what it really did. Do you recall when I was having a conversation with you and I said I had read right at the beginning of the year that some traders were abandoning their VIX strategies? And I know I wrote about it. And I said, it's almost a kiss of death. You want to lose on insurance policy. That's why they're an insurance policy. You're not looking for your home to burn down, but if it does, you want to make sure you're protected. Well, if the market goes not into necessarily a crash, but a big correction after getting up to 27,000 in the Dow day after day, month after month, okay. There's a time and place, and the VIX is now performing as it should. I don't know what more to say. This is performing as it should. That doesn't mean you have to go down every day, but we know higher interest rates are on the horizon. Why the market at the beginning of the year was hanging in like it was, if we come here, I can't answer. I don't know the answers to it. But this market was starting the fight right back here, and this is January 16th, and couldn't get over that 18-day average and started its move to the downside. And I think you'd agree. That was pretty much it. That's what I was looking at. Easy market to trade? Well, as long as you're under that 18-day average, you should be having bearish bias. In the bond market, same thing. Yes, risky. Yes, the market stuck its head up the other day when the stock markets crashed. People were running to it, and then you got this break back. And today, of course, you know, you don't expect this market. You expect it to get a bid, but I don't think the market's in the panic mode that it was that first day of a 1,400-point drop. That's what I'm trying to get at. The market in the Dow down 7 is half that amount. We're getting more used to the volatility now, and we're getting used to where the market is. 10-year notes. Yields are the 283 and a fraction, whatever it is, oversold condition. It stuck its head on this one rally, took the shorts out. I'd call it trendless, but a downside bias at this point. Dollar index has gotten a bid with all this. But the real question is, if the stock market keeps correcting, do people want to own that dollar that much? And again, don't lose sight that it's the U.S. that's raising rates. We haven't seen our trade partners really begin. They keep saying they're going to do it, and then they back away when it comes time to go through the door. We'll see if the dollar can get up to the upper Bollinger Band. That would be the resistance. Is it overbought? You're there already. You're in the 70s in this right now. Eurocurrency coming down for an oversold condition here. Support might be the lower Bollinger Band. Still have the pattern of a higher high, lower low. But now this market, it's corrected enough where now Mr. Draghi's going like this, the president of the European Central Bank, and going, ooh, the market's doing what we want. He was arguing that they were overvalued at 125. He didn't understand the value. Well, now you're back to 122 for all purposes. Bank of England, mixed messages today. One hand, they're real concerned about Brexit. What's it going to do? A lot of the banks haven't registered there. The other hand, the bank is saying that by May, they anticipate they're going to raise rates. That created an outside day up, but I think you'd agree. At the end of the day, a 40-point rally, 139.40, when you're up to 140.87, that was the initial reaction off the comment. Don't quite know what to do with that market either, a hard one to play there. These aren't easy times, and they're not always easy times. Sometimes, you know, you get lucky and you catch those easy ones. This is hard. The yen, I understand the bid. When people are scared, they buy the yen. I'll never understand from a fundamental point of view why that is the case. It's the way it works. Got the higher lows, you got the higher high, you're in an uptrend. The market is not in overbought status. It's knocking on the door. Wouldn't surprise me if the market, when things calm down, comes from an area like this and begins a correction. But you're not there. You're still very much in the upside. Take out today's low with an outside day up, and I'll change my opinion on this market. I will get real concerned about being bearish. I will change my position in the pound if today's low is taken out. That will be a failure. I would then look for the lower Bollinger Band to be hit. Bitcoin, I'm still showing the 15-minute chart because there's not enough data yet to show you on the futures contracts. They're getting close, but if I put just the daily up, it ends about here on our chart. And if I widen them, the chart makes no sense. Suffice to say, $6,000 looks too cheap. The market has come back, got up around the 8,700 level overall, and in between there, you're getting your crazy swings in the market. I know people tell me, oh, I saw a comment, you know, this chart is useless, the Brent versus the WTI. I saw one on the YouTube, and I started laughing. Maybe they don't understand the market. When the market was going sideways, I kept saying to people, look at the spread differential. That's where the pros are, and they're still in there. Now, I thought that maybe $3.50 was going to be the support zone. They went through that today pretty easy. So it's a question of where. But as this falls, and as you look at what Brent and crude are doing, WTI, you can see you got your lower highs, lower lows. Here's something to look at and do your own homework. I want you to go back to December and see how many individual charts in different markets were going sideways, broke out right around Christmas time, and went into vertical price rises, and how many are left doing that. Almost to the T, they're all done. So now you're getting the backdraft off of this. How low can Brent go? I don't know, but I'd say that because it's under the lower Bollinger Band 2 days in a row now, it's ready to bounce to the right-hand side at any point of the market, not changing the trend. The trend is down. A potential target might be 62.5 here in WTI. If it really washes out, could it be the $57.5, $55 range? It could be. You've just come from 66. You're already down in this market at today's low. If you look at it, you were down $6 off the high. But again, that sideways action when the market started stalling out is broken out to the downside. You're in a downtrend. Gasoline. Do you remember how everybody was bullish on this vertical rise? Okay? And then the market loses its embedded reading. Yes, the first objective is right here, but it's also a sign of loss of momentum. If the market falls apart, maybe it goes further down. So here it's fighting at the 18-day average, coming back up, back down. Gets first to what? The lower Bollinger Band. Fighting there. Now it's starting to break out of this sideways action. The next potential target, that's all that it is. Might it be, as traders look at the 100-day average? It could be. And here's the market going down to it. That's what charting is about. And that's really the simplicity of it. Now, as you know, I wrote a gold report, and I talked about it yesterday. If you haven't received it, the odds are you're not going to. So what you want to do is give us a call at 866-973-2077. You might want to click up here if you're watching me on YouTube, and you can fill out a form for our information. Just about any of it will get it there, but we'll see it, and we'll get the report out to you tomorrow. Underneath us on many websites, you can do that as well. With that, I'm Ira Epstein. You have a good day. I got my fingers crossed that I'll be here tomorrow.